Understanding internal rate of return, IRR, in commercial real estate, beyond cap rate. Tim Vi Tran, SIOR, CCIM, top CRE broker in Fremont and Silicon Valley, explains IRR, internal rate of return, and cap rate in commercial real estate for investors, buyers, sellers, landlords, and tenants. In our last article, we unpacked cap rate and NOI as the starting point for evaluating commercial real estate investments in Fremont, Silicon Valley, and the Greater Bay Area. Cap rate gives you a snapshot of risk and return of the first year of investment. Internal rate of return, IRR, answers a more advanced question. Given all of the cash in and cash out over my entire hold period, including my eventual sale, what is my annualized return on this deal? Understanding IRR is essential for comparing deals and making long-term decisions for investors, family trusts, and business owners building CRE portfolios of industrial, warehouse, office, flex/research and development, or lab space. Section 1. What is IRR in plain English? Here is a simple way of explaining IRR. You forecast your initial equity investment, annual cash flow, after operating expenses and debt service, your net sale proceeds at the end of the hold period. IRR is the annualized percentage return that makes these inflows and outflows break even in today's dollars. Corporate Finance Institute describes it as the expected compound annual rate of return on an investment. Investopedia describes IRR as the rate at which net present value, NPV, of future cash flows equals zero, a standard definition across finance. At its core, IRR is the discount rate that makes the NPV of all your projected cash flows, income and sale proceeds, minus your initial investment and capital costs, equals zero. For commercial real estate specifically, IRR is the percentage rate earned on each dollar invested for each period it is invested, applying the time value of money to property cash flows. Section 2. How IRR differs from cap rate. From our prior cap rate article for Fremont and Silicon Valley investors. Cap rate equals 1 year snapshot. NOI divided by purchase price. It tells you the unlevered yield today, assuming current income and market pricing. IRR equals full period view. It incorporates timing and size of all cash flows over the hold period, cash on cash income, capital expenditures, or capex, leasing costs, loan amortization, and eventual sale. Here are 3 key differences. Difference number 1, time horizon. The cap rate is year 1 or stabilized only. The IRR is from acquisition through sale. Difference number 2, what's included. Cap rate is NOI before debt and capex. IRR is equity invested, debt service, capex, leasing costs, and final sales proceeds. Key difference number 3, use case. Cap rate is a quick way to gauge pricing versus market and risk, and IRR compares overall investment performance between very different deals. In practice, sophisticated investors use cap rate to screen deals quickly, then use IRR to decide how and where to allocate capital. Section 3. How IRR is actually calculated without the heavy math. Without a simple algebraic solution for most real-world deals, investors let Excel or financial calculators do the work. In Excel, functions like IRR and XIRR for irregular dates solve for the rate that makes NPV equals zero. Many CRE-specific calculators and underwriting models do the same behind the scenes. From a decision standpoint, the classic rule is that a project is attractive if its IRR exceeds your minimum required return, often called your hurdle rate or cost of capital. Section 4. A property-level IRR example. Conceptual. Imagine a Fremont industrial condo or small warehouse. The equity invested, CF0, negative $2 million. Years 1 through 5 net cash flow, after expenses and debt service. Year 1, plus $80,000. Year 2, $100,000. Year 3, $120,000. Year 4, $130,000. Year 5, $140,000. Sale in Year 5. Net equity proceeds after closing costs, plus $2,600,000. If you plug these cash flows into an IRR or XIRR function, you might see an IRR in the low to mid-teens, meaning your equity effectively compounds at roughly that rate over the full 5-year hold. Change the timing and shape of the cash flows, and you change the IRR, sometimes drastically. Section 5. Why timing matters so much for IRR. IRR rewards earlier cash flows and penalizes later ones, and this is both the strength and weakness of IRR. Black Diamond Realty illustrates this with examples. Investments with similar total profits can have very different IRRs if one produces cash earlier, leased quickly, minimal downtime, and another backloads profits at sale. For CRE investors, that means a project that stabilizes quickly through fast lease-up, strong tenants, with minimal capex surprises, often shows a higher IRR than a deal with similar profit but long lease-up or heavy renovations. Two properties with the same projected total profit over 10 years can have very different IRRs based on when that profit is realized. This is why many investors establish a hurdle rate, the minimum IRR they're willing to accept given their risk tolerance and alternative opportunities. Section 6. IRR in commercial real estate underwriting. In commercial real estate, IRR is used at several levels. Level A, property level IRR. Sites like commercialrealestate.loans show how investors use IRR to compare deals of different sizes and structures over a multi-year hold. For example, you might compare a Fremont industrial building with strong tech or logistics tenants, modest leverage, and a projected IRR of 11 to 12% versus a secondary market office deal with more leasing risk, but a projected IRR of 17 to 18%. IRR helps you see whether the extra risk and complexity justify the higher projected return, especially if your real objective is wealth preservation and stable income. Level B, fund level/portfolio level IRR. At the institutional level, IRR is also calculated across entire funds or portfolios. Fund level IRR helps compare strategies, sponsors, and vintages, especially from the perspective of limited partners, LPs, and general partners, GPs. At the same time, institutional investors track performance against indexes such as the NCREIF Property Index, NPI, which measures property level returns for core institutional assets across the US. For a private investor or family trust, you don't need that level of infrastructure, but the principle is the same. IRR is one of the key metrics professional investors use to judge manager performance, strategy quality, and portfolio construction. Section 7. The limitations of IRR and why you shouldn't rely on it alone. IRR is powerful, but it is imperfect. Your underwriting will be stronger when you understand its weaknesses. A. Reinvestment assumption. Traditional IRR implicitly assumes that interim positive cash flows can be reinvested at the same IRR, which is rarely true in the real world. Both Investopedia and commercialrealestate.loans flag this as a core limitation. B. Multiple IRRs for unusual cash flow patterns. If your cash flow stream switches sign more than once, for example, additional big capital injection midway through the hold, you can end up with multiple IRRs or none at all. Corporate Finance Institute and others note this issue in capital budgeting analysis. C. Scale and absolute dollars. IRR is percentage-based and can be misleading when comparing deals with very different sizes of equity or profit. Commercial Real Estate.Loans points out that a smaller investment with a very high IRR may be less meaningful than a much larger investment with a slightly lower IRR. D. Sensitivity to early cash flows. As said earlier, front-loading cash flow tends to boost IRR, which can over-reward short-term flips or aggressive assumptions about lease-up and rent growth. E. Not a standalone decision tool. Professional investors evaluate projects with multiple metrics such as IRR, equity multiple, cap rate, NPV, and benchmark comparisons, instead of a single number. Section 8, MIRR, a more realistic cousin of IRR. To address some of IRR's weaknesses, many analysts look at MIRR, or Modified Internal Rate of Return. According to Commercial Real Estate.Loans, MIRR assumes interim positive cash flows are reinvested at a realistic reinvestment rate chosen by the investor. It also incorporates a finance rate, or your cost of capital, for negative cash flows. The result is a single, more stable rate of return that often better reflects actual investor experience. For sophisticated CRE investors, running both IRR and MIRR can highlight how sensitive your projected returns are to your reinvestment opportunities and financing costs. Section 9. How IRR fits with your other CRE metrics. In practice, we recommend investors view IRR as one piece of a larger toolkit. Cap rate, quick view of current yield and relative pricing, cash on cash return, near-term income as a percentage of equity, IRR/MIRR, full period annualized return, accounting for timing, equity multiple, total cash returned divided by total equity invested is a simple measure of how many times you get your money back without time value assumptions. Together, these metrics help you answer: is this property priced correctly for its risk profile? How does this deal compare to other opportunities? Does this investment help me meet my long-term wealth and income goals? Section 10. Practical tips for Fremont and Silicon Valley CRE investors using IRR. For owners, investors, and operators focused on Fremont and Silicon Valley, especially in industrial, warehouse, R&D, and related sectors, here is how we suggest using IRR. Number 1. Set a realistic hurdle rate. Consider your opportunity cost. What could your capital earn in other conservative investments? Adjust upward for asset risk, tenant quality, market volatility, and execution risk through leasing, capex, or development. Number 2. Stress test assumptions, not just the IRR output. Run multiple scenarios for exit cap rates, like what if cap rates move 50 to 100 basis points against you, rent growth and downtime between tenants, interest rates and refinance risk. See how quickly your IRR moves when key assumptions change. 3. Compare IRR across markets and asset types. A moderate IRR on a well-located Fremont industrial facility leased to strong credit tenants may be preferable to a higher IRR in a weaker market with more volatility. Pay attention not only to the number, but to the quality of the underlying income. Number 4. Integrate IRR into 1031 exchange planning. When trading out of a down leg property, analyze the blended IRR of your potential replacement assets or portfolio. Make sure your 1031 strategy aligns with your risk tolerance, timeline, and estate or tax planning, in close coordination with your CPA and legal advisors. Number 5. Review IRR periodically, not just at acquisition. As rents reset, capex plans change, or debt terms shift. Update your pro forma and see how the projected IRR evolves. Use this to inform hold versus sell decisions and to time refinancing or capital improvements. Section 11. How the Ivy Group approaches IRR with clients. Our role as a commercial real estate advisor is to demystify metrics like IRR and tie them back to real-world decisions. We build and review cash flow models that incorporate rent rolls, operating expenses, TI/LC, tenant improvements and leasing commissions, debt, and sale assumptions. We evaluate deals through multiple lenses: IRR, cap rate, equity multiple, and risk profile, instead of a single headline number. For 1031 exchange scenarios, we compare potential replacement properties and structures, single tenant versus multi-tenant, local versus out of state, different leverage levels, using consistent underwriting. We bring an owner/investor mindset, informed by SIOR and CCIM training and decades of experience, to help you understand not just, can this hit a 15% IRR, but what has to go right to hit that 15%? And how comfortable are you with those assumptions? If you are considering buying, selling, or repositioning commercial property in Fremont, Silicon Valley, or the broader Bay Area, a clear understanding of IRR is one of the tools that will help you make more confident, better informed decisions. To learn more, you can access, for a small fee, case studies at theivygroup.com/courses. Subscribe to the Ivy Group newsletter at theivygroup.substack.com. Contact the Ivy Group at theivygroup.com/contact-us. About the Ivy Group. The Ivy Group specializes in commercial sales, leasing, and investment advisory across Fremont, Silicon Valley, and the Greater Bay Area. With over 100 years of combined experience and designations including SIOR and CCIM, the Ivy Group provides strategic guidance for complex transactions in commercial real estate. When you need to sell, buy, or lease, the Ivy Group is ready to help you reach your goals. Contact us with your next real estate needs. Disclaimer: all information shared here in this article and in all blogs, case studies, and courses offered by the Ivy Group are for general education only, not as tax, legal, or investment advice. Please seek professional advice from tax, accounting, legal, and other professionals.